this opportunity of a little bit of lull in the markets to turn our attention towards a new environment that is emerging in the infrastructure space, specifically roads. It gives me great pleasure to welcome Sandeep Upadhyay, Managing Director and CEO at Centrum Infrastructure Advisory. Sandeep, good to have you here on NDTV Profit. Let's just dive right into it. There seems to be activity picking up in the road sector. When I say activity, I mean deals picking up. What explains it?
So certainly the M&A activity has picked up over the last 6 to 9 months. In fact, lately we had one of the largest deals announced in the road sector, which was again oriented more on the M&A front. Let me try and give you a perspective as to what is driving this, from the sell side as well as from the buy side. I think what we are witnessing today is a lot of these EPC companies are stressed out. And the ones who really dabbled into the BOT space, where incidentally they've ended up owning BOT assets, they are the ones who are essentially looking to monetize these assets with a simple theory that they are able to deleverage themselves. And I think that is the need of the hour for a lot of these EPC companies. On the buy side, I think the Indian strategics still are reluctant in terms of doing the acquisitions because they have their own set of challenges. However, what comes as a fresh breath is the interest coming in from the pension funds and the sovereign funds. I mean, this is actually a new investor class which is essentially evaluating the matured infrastructure assets, and that's what is really driving the the buy side appetite.
I just want to flesh out what you said in terms of buy side appetite. Surely, it's not all a path laden with roses in a sense when it comes to roads and infrastructure projects in India. So, how do you deconstruct the interest from the pension funds? I want you to get a little more granular about why they're interested.
Yeah, so, traditionally if you see some of these matured countries which are there in Europe, which are there in US, you have these pension funds who've got a mandate to own or to invest essentially in assets which can give them stable forms of returns. Incidentally, in the road sector, some of these assets have matured to that stage. Okay. And the pension funds, essentially dabble into, return thresholds where post-tax equity IRRs would range anywhere between 14 to 17%. Incidentally, some of these road sector deals which have happened in, these kind of ranges. And given that, there is so much of stress which is there in the infrastructure sector, I think it'll continue to be a buyer's market.
Okay, so you're basically saying that valuations are very reasonable for these deals. I mean, what's that matrix looking like?
So I think the most fundamental way of dissecting any infrastructure asset from a valuation perspective would be to understand from a DCF concept, the discounted cash flow method. Clearly, about 15 or 16 deals have been announced in the road sector, and if one were to map the valuation matrix, these are all deals which have happened from an equity IRR construct point of view, anywhere between a 14 to 18%. The 18% deals have actually happened in cases where there has been a distressed sale, the furnaces where the form of cash flows have been a little bit more robust and stable.
Okay. Are there any repercussions that we should pause to consider now that you've got sort of a new class of investors in the road space?
The repercussions are all positive. I think this is something which also has been facilitated by some initiatives taken by the government. Probably about a week back, there has been a 100% exit formula announced by the government. And that, to my mind, I think was a no-brainer, should have been done way back, at least 2-3 years back. Having said that, I think it's a good head start for some of these pension funds. The repercussions it will definitely have is a lot of these equity which has been blocked in operational assets will actually get freed up for the EPC companies and the BOT companies to bid for the new projects. And hence, I think when we talk of the grand $1 trillion plan of investment into the infrastructure space, I think this freed up capital will play a very significant role in terms of fueling the further capex. Having said this, I think the $1 trillion number itself has been iterated, given that the first 2 years in the 12th plan was kind of a whitewash.
If that, you're being gentle and kind in that. I just want to understand if you see any immediate challenges for this new class of investors, because it's good to sort of flag them off right up front, because it could pose to be tricky going forward. Any huge challenges that the government should be directing its attention towards?
Sure. I think the biggest challenge was the exit, the 100% exit, which has now been allowed. I think once you have a series of these acquisitions happening, which is, by the way, happened for the first time. I think this has started happening since about 2 years back. And as I said, there are about 15, 16 assets where investors with a financial DNA have ended up taking a buyout position. The key features or the key challenges here, which are still there to be looked at from a buy side point of view, is how are the lenders going to behave with these pension funds? Because typically, if you see most of these assets, the promoters would have either given a personal guarantee or a corporate guarantee. Now, when these assets are taken over on an enterprise value concept, the debt obviously, has to be transferred to the pension funds. And by the way, the pension funds or these long-term financial investors do not really have a mandate to give a corporate guarantee kind of, that's not there in their DNA. So probably we will have to see that the banks will have to refine the means of financing more from a non-recourse point of view.
No, just in simple terms, explain what that means.
That clearly means that, because the pension funds would not have the bandwidth of giving a corporate guarantee,
sure,
the lenders will have to resort to pure cash flow based financing.
Okay.
And by the way, that is, the lenders will continue to be the biggest stakeholders of some of these assets, right? Because these assets are all funded at a debt equity, which is 70-30 or maybe 80-20. So the lenders will have to rejig on their formula. Of course, the other aspect is on the operational part, where O&M will be a major challenge for some of these pension funds. I think the quality of construction will also play a major role in terms of the diligence which some of these pension and sovereign funds will have to do. So it has to be a blend of the capex plus opex model, which will actually result in the ultimate winner.
So it's not as easy as, I was setting out at the start of this conversation believing. Let's just try and understand where we go from here, because we've spent, I think, a large chunk of the last decade defining the road sector as stressed. What does the, immediate near-term future look like, whether it comes to capacity to invest, types of projects, types of structures? Lay the roadmap for us.
So I think the government will definitely have to iterate their strategy in terms of their rollout plan. So we have actually come out of the phase which was euphoric. I don't think we are going to go back to those 2007 days where, you will have portfolio of assets where investors would invest and, take a pick in assets which are half completed. Essentially, you will have, growth driven by the fact that government will have to change their strategy in terms of implementation plan. So I see more and more EPC projects coming up. I think it's a very smart move to head towards a hybrid model, which is actually a combination of annuity plus viability gap funding. These projects are going to be rolled out. But the ministry, I think, has worked fantastically well from the structuring point of view, because BOT is going to take a back seat. And it is the EPC which is going to drive the road sector for the next 2 to 3 years. I think till the time the stakeholders again start reviving their interest in terms of, taking any stake in an underdevelopment asset. Yes. Till then, I think a lot of financing will have to be done on behalf of the government. I see NHAI really, coming out with bonds, which would essentially be used for doing the capex